Your childhood toy costs more today. Now think about trying to buy that same toy today. Chances are it would cost more. That's inflation in a nutshell. Inflation is the rise in the general price level over time, making your money worth less. So let's dive into what exactly inflation is and how it affects you. First things first, let's talk about how inflation works. When the economy grows, prices tend to rise because there's more money circulating relative to the supply of goods and services. Imagine a hot summer day where everyone wants ice cream. If the ice cream shop can't produce enough to meet the demand, each ice cream cone becomes more expensive. That's how inflation starts. Now let's look at a real-world example. S experienced high inflation rates, reaching around 13% at its peak. That means prices could double in just under 6 years if inflation remained at that rate. If you had $100 in 1970, it would be worth less than $50 in terms of buying power by the mid-1980s due to the cumulative effect of high inflation over that period. So your money was losing value. But how do we measure inflation? Economists use something called the Consumer Price Index, or CPI. The CPI tracks the cost of a fixed basket of goods and services, including food, housing, and transportation. It gives us a clear picture of how prices are changing over time. For instance, if the CPI increases by 3%, it means that prices are 3% higher than they were in the base period, typically a year earlier. Here's a concrete way to think about it. Imagine you buy a gallon of milk for $3 today. Over time, the cost of that milk keeps climbing, making your purchasing power decrease. This is false. Inflation impacts everyone regardless of income. If you're on a fixed income like a pension, inflation can eat away at your purchasing power. Let's say you have $1,000 a month in retirement savings, $87 worth of goods next year. That's a real hit to your budget. So how do we protect ourselves from inflation? One way is to invest in assets that historically hold value better than cash. For example, stocks and real estate often outpace inflation over the long term. But here's the rub, not all investments are created equal. Let's look at the numbers. A $10,000 investment in the stock market in 1980 would be worth around $70,000 today, adjusted for inflation. But if you had kept that same $10,000 in cash under your mattress, it would only buy you $3,000 worth of goods today due to inflation eroding its purchasing power. That's the power of investing over holding cash. Another key strategy is to diversify your investments. Don't put all your eggs in one basket. A mix of stocks, bonds, and real estate can help hedge against inflation. But it's not just about what you invest in. When you invest also matters. Timing the market is tricky, but investing consistently over time, especially in low-cost index funds, can help you build wealth and potentially stay ahead of inflation. But here's a reality check. Investing isn't a guarantee. It comes with risks. Stocks can plummet and real estate markets can crash. Remember the 2008 financial crisis. Home values dropped sharply and many people lost a significant amount of money. So while investing can be a powerful tool against inflation, it's not a surefire way to get rich quick. Now let's talk about another important factor, interest rates. When interest rates rise, it can help slow down inflation. This is because higher rates make borrowing more expensive, which can dampen consumer and business spending. For example, if you're considering buying a house, higher interest rates mean higher monthly payments, making you less likely to take out a mortgage. This reduced demand can help keep prices from rising too quickly. But here's the twist. Higher interest rates also mean higher costs for businesses as borrowing becomes more expensive. While businesses can sometimes pass these costs on to consumers, driving prices up, this is not always feasible without losing competitiveness. It's like a tug-of-war between keeping prices stable and managing borrowing costs. The Federal Reserve tries to balance this by adjusting interest rates, but it's never a perfect science. Now, let's zoom in on a specific tool, the emergency fund. An emergency fund is a stash of cash set aside for unexpected expenses. But here's the catch. Inflation erodes the value of that fund over time. If you keep your emergency fund in a savings account that earns less than the inflation rate, the purchasing power of that fund will shrink as prices rise. So your emergency fund needs to earn enough to at least keep up with inflation. One way to do this is by investing your emergency fund in something like a short-term bond fund. These funds typically earn more than a regular savings account and can help your money grow at a rate that may outpace inflation over time. But again, remember the risks. Investing in anything other than a savings account means you're taking on some level of risk. Now let's talk about the psychology of inflation. People often underestimate how quickly prices can rise. It's like a slow burn that can catch you off guard. But over time, those small increases add up. This is why it's crucial to monitor your expenses and adjust your budget as prices increase. But here's the tricky part. When prices rise, people tend to cut back on non-essential spending. This can be challenging if you've already minimized your expenses as much as possible. It's like being in a race where the finish line keeps moving further away. So it's important to plan ahead and build in flexibility to accommodate unexpected costs. Now let's circle back to key question. How do you know if inflation is affecting you? One way is to track your spending. If you notice that your monthly bills are increasing, that's a sign. Or if you find yourself buying less of something you usually buy because it's too expensive, that's another clue. It's like a detective game, look for those subtle clues. But here's a critical takeaway, inflation is inevitable. It's a part of the economic cycle and there's no way to completely avoid it. So the goal isn't to eliminate inflation but to manage its effects. By understanding how it works and taking proactive steps, you can protect your purchasing power and financial future. Now let's talk about some common misconceptions. One big myth is that inflation only happens during economic booms. This isn't true. Inflation can occur during any economic phase, even during recessions. For example, after the 2001 recession, Japan experienced deflation, but as the economy recovered, inflation returned. Another myth is that inflation is always bad. While high inflation can be problematic, moderate inflation is actually healthy. It indicates that the economy is growing and people are spending money. However, if inflation gets too high, it can become a problem. That's why central banks aim for a target inflation rate, typically around 2%, to maintain economic stability. So how do you navigate inflation? The key is to be informed and proactive. Monitor your expenses, diversify your investments, and adjust your emergency fund to keep up with inflation. It's like tending to a garden, regular maintenance keeps things healthy. Now let's talk about one more critical aspect, the long-term impact. Inflation can slowly but surely erode your retirement savings. If you're planning for retirement, it's important to factor in inflation. For example, if you plan to live on $50,000 a year in retirement, that amount might need to be significantly higher to keep pace with inflation over several decades. That's why it's crucial to save more than you think you'll need to maintain your standard of living. But here's the flip side. Inflation also creates opportunities. It can spur innovation and drive economic growth. For instance, when prices rise, businesses might seek ways to produce goods more efficiently, leading to new technologies and products. So while inflation can be challenging, it's also a part of how the economy evolves. In summary, inflation is a complex and ever-present force in the economy. By understanding how it works and taking proactive steps, you can protect your financial future. Here's the takeaway. Inflation is like a steady stream, quietly eroding your purchasing power. But by staying informed and taking action, such as diversifying your investments and choosing assets that historically perform well during inflationary periods, you can build a financial foundation that stands strong against its flow. Note that this information is for educational purposes only and does not constitute financial advice. Inflation isn't just about rising prices, it also affects your savings. When inflation outpaces your savings account interest rate, the value of your money decreases over time. For example, if your savings earn 1% annually but inflation is at 2%, the real value of your savings is dropping by 1% each year. To combat inflation, consider investing in assets that historically have tended to grow faster than inflation, such as stocks or real estate. These assets can help maintain or even increase your purchasing power over the long term. But remember, investing always comes with risk, including the risk of losing money. Another key strategy is to diversify your portfolio. Don't put all your eggs in one basket. Spreading your money across different types of investments can help protect you from the effects of inflation by reducing risk. Think of it like a weatherproof jacket with multiple layers. Each layer helps shield you from the cold. Lastly, keep an eye on your fixed expenses. Inflation can drive up costs for things like rent, utilities, and groceries. Adjusting your budget to account for these increases can prevent you from falling behind. It's like checking the tires on your car before a long trip. Small steps today can prevent bigger problems later. Tomorrow on the Money Files, tariffs and trade. This is educational and historical, not financial advice.